Hi, welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. Now, we just went through, or in the middle of the second quarter earnings seasons, not just for the US, but also for a lot of the Asian companies as well. And clearly, there's been a lot of events, a lot of excitements, both in terms of tariffs, in terms of AI developments, and of course the underlying growth momentum of Asian economies. So in today's episode, I would like to walk you through our thoughts on what's happening with APAC earnings in the second quarter. What is it telling us? And of course, most importantly, what does that mean for investors? I'm delighted to be joined by one of our global market strategists, Adrian Wong, who just wrote a paper on this very topic this week. So Adrian, thanks for joining us.
Thank you for having me.
Okay, so maybe let's start with the big picture. And can you give us an overview of the second quarter earnings from Asia Pacific so far?
Sure, Tai. So 2/3 of the APAC market have released second quarter earnings so far. Reported earnings growth are looking at a 4.8% year-on-year growth and revenue growth at 11.3%. So albeit not quite a stellar quarter, given the challenging external environment, such as tariffs, which have pressured on margins. However, overall results were generally more resilient than expected. In fact, looking at APAC as a whole, earnings have come in at about 4.6% above estimates, and revenue at 9.8% above. Many of the mega caps, of course, have done the heavy lifting, but breadth matters here too. We find that about 2/3 of the companies have delivered results in line or even better than market expectation. So whilst not uniform pattern here, we've seen some sectors and some markets perform better than others, much like how different company managements have been deploying different strategies and have been differently explaining the Q2 results and guiding future expectations over the earnings call so far.
Okay, so I think that's a really interesting starting point where the overall picture is decent. But I think what you can share with us a little bit more in a minute is how this breaks down into different sectors and also different factors driving earnings performance so far. So I think let's start with the elephant in the room in terms of tariffs. So obviously we've been dealing with President Trump's tariff policy for much of 2025. What have we observed from these earnings results and what's been the impact so far?
Sure. So tariffs was implemented in the middle of quarter. The focus is obviously on the impact on profit margins on these Asian companies, especially those that are very export orientated. Japanese and the broader Asian auto sectors came into focus, with US accounting for 36% of the segment's revenue, which is much higher than the market average of 16%. Autos import in the US were actually subject to 25% tariff rate for most of the quarter. Obviously, this was a large attraction to profits for Japanese car makers and has seen a hit to profit margins ranging about 3 to 4 percentage points. Tariffs, which run through the full quarter going forward, is also one of the focus in earnings calls. Some companies are expecting actually a shallower margin hit with only a modest revision to guidance. This is obviously a result of the new trade agreement introduced in August, which is reducing tariff rates for Japanese autos to 15%. Companies are also actively expanding their US-based production, which are avoiding tariffs for their domestic market, while minimal price increase observed so far is also offering a room for potential price hikes for these Japanese car makers in the future. So in fact, we've seen so far very minimal price increases so far, and there's also room obviously for potential price hikes in the future for all of these Japanese automakers. So what we expect now is that tariff burden may actually gradually shift from exporters to consumers and thereby actually easing the pressure on profit margins. Another sector of focus is obviously the technology sectors, with US making up 37% of the Asia technology sector's total revenue. Of course, US tariffs, which was announced under Section 232, semiconductors were actually threatened with a 100% headline tariff rate earlier this month. However, we noticed that dynamics are slightly different in this market. First off, exemptions were actually made for companies who have pledged high levels of investment in the US. Most leading names in Japan, Korea, or even Taiwan are actually planning or already committed to the US productions. Leadership in this technology manufacturing, from semiconductors and memory chips all the way down to manufacturing machines, should also prove resilient given how AI supply chain should remain a seller's market. As a result, this means that buyers are likely to bear a larger share of tariff burden, whereas exporters in Asia would experience a buffer to their profit margins, if AI advancements sustain demand for AI chips and equipment.
So you touched on a really interesting point about AI and technology. I'll come back to this point in just a second, but it's worth just highlighting the need for active management. In the auto sectors, not every car companies have done the same in terms of investing in the US and therefore be able to avoid some of the tariff impact on technology. I think you touched on a really interesting term where who is the price taker, who's the price giver. In some areas like semiconductors, many Taiwanese companies at the cutting edge, they could be the price giver. Whereas the importers on the US side, they could be the price taker. So I think, while it's very simple and very easy for us to map the export exposure of individual economies in the APAC region and the potential impact from tariffs, but the reality is at a corporate level, there's still a lot of work, a lot of research that needs to be done to fully appreciate the impact of tariffs. So let's come back to the point of AI. This has been another dominant theme for APAC equities in 2025, both in terms of hardware, in semiconductors, in memory chips, but also in software and services, especially coming from China. What do we see there?
Sure. So technology sector as a whole have seen reported earnings growth at about 14% year on year. Of course, results were very upbeat, which suggests that AI demand continues to outpace supply. But there are two sides of this story, the hardware side and the software side. On the hardware side, we saw two main trends within the chip manufacturers. First off, there's a larger share of AI chips demand being shifted to more complex models. This is, of course, to facilitate more efficient computation. Names like the semiconductor chips manufacturers have seen improvement across speed, power, and density on the newer chip models. Because more complex chips could be better suited for applications in both smartphones and high-performance computing, demand for these new chips are actually expected to surpass that of the previous models at launch. Companies are also gradually shifting their production mix towards these more complex chips. First off, to capture the increasing demand at the higher end market, and organically also lifting the average selling price, offsetting the increased US production, which are usually more higher cost. On the second point, we'll also see the total AI chip demand is also larger as AI application broadens out. Memory chip names have seen demand widening from training computation to now inferencing computation on reasoning and agents. Increased AI workload globally and intensifying bandwidth bottlenecks will push growth in computation volume demand and therefore continue to lift the total market demand for memory chips, especially for high bandwidth memory chips, which is a key product for performance enhancement. So in both cases, whether it's a larger share or even just a larger pie, we've been observing that companies are announcing further capex to boost supply, which again reiterates the point about seeing more and more of a demand-led market expansion. Now that's the hardware side of the story. On the software side, we're also seeing capex momentum being very apparent and continuing, especially with some of the leading Chinese internet companies, as we see AI adoption delivering proven results in driving revenue growth. Expanding use cases from more immediate external services such as just simple GPU rentals or API token usage for cloud operators, to even internal use case such as improving advertising suggestions with higher click-through rates and AI-powered game production. This higher capex is used to support a more wider range of AI use cases, which offers more ways for companies to monetize AI developments. Of course, we've seen some volatile news over overseas chips controls, but that doesn't actually mean Chinese companies are slowing down on their capex. In fact, they're exploring other available options for inference chips, whilst at the same time continuing to execute other software improvements to drive inference efficiency to sustain higher AI workload. So stepping back, we see the industry gradually shifting AI demand from external services, which are more immediate in turning AI demand into profits, to internal adoption, which sees large room for upside to monetize AI later in the future. As we get higher and more efficient AI investment ahead, this should mean that companies are able to improve monetizing AI capabilities, turning them into earnings growth.
No, that's great. So obviously, Asia is more than just exporters and technology. Are there any other noteworthy sectors or bright spots that we see in the region?
Sure. So Chinese e-commerce industry, not necessarily the brightest spot though, is due to report results later this month. And recent attention has been focused on the escalation of price competition, which could weigh on profit margins over this quarter. However, given meaningful differences in their financial resources and also regulators stepping in to address further involution, we see a case that this competitive intensity could moderate ahead. Elsewhere, financials and banks generally have been more sheltered from tariff risk and are more tied to domestic developments. Indian banks, for example, continue to see higher quality names outperform in earnings results, despite some pressure on interest margins and then asset quality in the sector. But the real spotlight has been on Korean banks, which has delivered some strong results over Q2. This is thanks to some strong non-interest income, as fee income recovered and high trading gains in the rate cut environment, as well as manageable credit cost and stable net interest income. Signs of peaking delinquencies at some of the larger banks also helped. But arguably, the most positive development has been the larger than expected share buyback announcements from Korean banks, which continue to contribute to the progress of enhancing for total return shareholder returns. Again, a broad theme that will remain constructive on many APAC markets.
No, that's great. So that's really interesting in a sense that obviously a lot of the spotlights for international investors have been on the impact from tariff, which we discussed at the start, and then development of technology and AI. But at the same time, there are other opportunities within Asia. I think the Korean financial sector, the banks, is a really interesting example. Not only their earnings outlook or performance is improving, but their corporate governance is also moving in the right direction, which in some ways are very similar to what we saw or experienced in Japan in the past few years. So again, I think the key here is very much thinking about active management and looking into different markets within Asia, but also different sectors and different companies. So let's wrap this all up. What are maybe 2 or 3 key takeaways for investors in APAC?
Sure. So as you've alluded to, even though tariffs and AI have captured much of the recent market's attention, we think that investors should focus on the fundamentals and not the noise when it comes to the Asian market. There are many companies, sectors, and markets that are either more sheltered from tariff risks, more resilient, or are actually actively mitigating this risk than meets the eye. There's also a broad range of AI-related companies that are either already benefiting from higher AI demand, such as the upstream chip manufacturers and cloud operators, or starting to finally monetize AI, such as the more downstream application developers. This is of course not to mention the ongoing corporate governance and value-up programs which have been gathering much success across Asia. Case here is that we see these themes continue to evolve swiftly for the rest of this year. So having a robust fundamental research and the ability to dynamically manage these exposure through active management will remain a key differentiator for investors in this market.
So look, I think if you look at the overall global asset allocation recommendation that we've been suggesting to investors across the region, of course, there's still plenty of attention on the US equity markets. But at the same time, I think there have been some very pleasant surprises that we see in Asia or in APAC in 2025. In many of these sectors, we think that the performance is sustainable, it's manageable. And again, coming back to Adrian's point, finding the right companies, finding the right sector that can continue to deliver shareholders' return, that's very much our key objective. So Adrian, thank you very much for your insights and sharing, and also thank you for joining us on this episode. If you have any questions or comments, feel free to reach out to your JP Morgan Asset Management client advisors. And if you like this podcast or this episode, Of course, feel free to subscribe and recommend this to your friends and colleagues. I'm Tai Hui, and I'll see you next episode to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.